In 2018, the Bank of England raised its base rate from 0.5% to 0.75%. This meant that many banks and lenders in the UK also raised their interest rates on savings accounts, mortgages, and loans. As a result, people with savings accounts benefited from higher interest rates as they were able to earn more money on their savings. However, those with variable rate mortgages saw their monthly mortgage payments increase as the interest rate on their mortgage increased in line with the base rate. Interest rates have been used by banks as a tool to control inflation for decades. The idea is simple. When inflation is high, raising interest rates can reduce the amount of money available to consumers and businesses, which can help to slow down the economy and control inflation. On the other hand, when inflation is low, banks may lower interest rates to encourage borrowing and stimulate economic growth. One of the most famous examples of a bank raising interest rates to control inflation is the Volcker shock in the 1980s. Paul Volcker was the chairman of the Federal Reserve at the time, and he made the controversial decision to raise interest rates to unprecedented levels to combat high inflation. The move was initially unpopular and caused a recession, but ultimately it was successful in reducing inflation and laying the groundwork for a period of economic growth. More recently, the Federal Reserve has raised interest rates in response to a low unemployment rate and rising inflation. In 2018, the Federal Reserve raised interest rates 4 times throughout the year in an effort to keep inflation under control. The decision was met with mixed reactions, with some experts arguing that raising interest rates could slow down economic growth and hurt businesses and consumers. However, the Federal Reserve felt that it was necessary to raise interest rates to prevent inflation from getting out of control. By raising interest rates, the Federal Reserve hoped to encourage consumers and businesses to save more and borrow less, which would ultimately help to slow down the economy and prevent inflation from rising too quickly. It's worth noting that raising interest rates is not always a popular decision. Consumers and businesses may feel the effects of higher borrowing costs and reduced economic growth, which can lead to pushback against the decision to raise interest rates. However, if inflation is left unchecked, it can have far-reaching and long-lasting effects on the economy, such as reduced purchasing power, higher unemployment, and slower economic growth. But why do banks raise interest rates in the first place? Interest rates are one of the most important tools banks use to manage the economy. When banks raise interest rates, it can have a big impact on everything from inflation to your personal finances. So let's talk about some of the reasons why banks might choose to raise interest rates. First up, controlling inflation. Inflation is when the price of goods and services increases over time, making your money worth less. If inflation gets too high, it can have serious consequences for the economy as a whole. That's where interest rates come in. When banks raise interest rates, it can reduce the demand for money, which can help to control inflation. Essentially, higher interest rates make it more expensive to borrow money, so people and businesses may be less likely to do so. This can help to slow down the economy and bring inflation under control. Next, attracting deposits. Banks are always looking for ways to attract more deposits because that's how they make money. One way they might do this is by raising interest rates on their savings accounts, or CDs. When banks offer higher interest rates, it makes their accounts more attractive to customers who are looking to earn more money on their savings. This can help banks to attract more deposits and grow their business. Another reason for raising interest rates is to respond to changes in the economy. The economy is always changing, and banks need to be able to respond to those changes. For example, if the government introduces new policies that impact the economy, banks might need to raise interest rates to account for those changes. Or if there's a sudden increase in economic growth, banks might raise interest rates to prevent inflation from getting out of control. Similarly, if credit becomes more widely available, banks might raise interest rates to prevent the economy from overheating. All of these reasons for raising interest rates are important, but they can also have some unintended consequences. For example, when banks raise interest rates to control inflation, it can make it more expensive for people and businesses to borrow money. This can slow down the economy and make it harder for businesses to grow. Similarly, when banks raise interest rates to attract deposits, it can make it more expensive for people to borrow money, which can also slow down the economy. And when banks raise interest rates in response to changes in the economy, it can be hard to predict what the impact will be. How does raising interest rates affect inflation? Have you ever wondered why banks raise interest rates and what impact it has on the economy? Well, one of the main reasons why banks raise interest rates is to control inflation. When inflation is high, banks may raise interest rates to reduce the demand for money, which can help to control inflation. But how exactly does this work? And what are the implications of higher interest rates on inflation? One of the main implications of higher interest rates on inflation is that it can help to reduce inflation by decreasing the amount of money available to consumers and businesses. When interest rates are high, it becomes more expensive for consumers and businesses to borrow money, which means they are less likely to spend money. This decrease in spending can help to reduce demand and ultimately bring down prices, leading to lower inflation. However, higher interest rates can also have negative implications on the economy. One of the main negative implications is increased borrowing costs. When interest rates are high, borrowing money becomes more expensive for businesses and consumers. This can discourage borrowing and investment, which can hurt economic growth. For example, businesses may put off new projects or expansions if they cannot afford the higher borrowing costs, which can lead to slower economic growth. Another implication of higher interest rates is increased savings rates. When interest rates are high, it becomes more attractive for consumers to save their money in interest-bearing accounts rather than spend it. This increase in savings can reduce consumer spending, which can lead to slower economic growth. For example, if consumers are saving more and spending less, businesses may experience lower demand for their products and services, which can lead to slower economic growth. So, what does this mean for you as a consumer or business owner? As a consumer or business owner, it's important to understand the implications of higher interest rates on your finances. When banks increase interest rates, it can have a significant impact on your borrowing and saving decisions. If you are a borrower, higher interest rates mean that borrowing money will become more expensive. This can include things like car loans, mortgages, and credit cards. As a result, you may want to consider paying off your debts or consolidating your loans before interest rates rise further. For those with adjustable-rate mortgages or loans, higher interest rates could mean that your monthly payments increase. This can put a strain on your budget and make it harder to keep up with payments. It's important to keep an eye on interest rates and adjust your budget accordingly if needed. On the other hand, if you are a saver, higher interest rates can be a good thing. This is because banks will offer higher interest rates on savings accounts, CDs, and other financial products. This can provide an opportunity to earn more money on your savings, which can be especially helpful if you're saving for retirement or other long-term goals. However, it's important to remember that higher interest rates can also lead to slower economic growth. This can affect businesses and job opportunities, which could impact your personal finances. For example, if businesses are experiencing lower demand for their products or services, they may not be hiring as many employees or offering raises and promotions. Banks have used interest rates as a tool to control inflation for decades, and historical and recent examples demonstrate the effectiveness of this strategy. While raising interest rates may not always be a popular decision, it can ultimately help to prevent inflation from getting out of control and ensure long-term economic stability. As consumers and businesses, it's important to pay attention to changes in interest rates and understand their potential impact on the economy.